Believe it or not, you'll be retiring with a lot more money depending on whether you choose to pay off your mortgage sooner or whether you choose to invest that money instead. What is better for you will depend on your current situation, which I'll break down in this video. We'll go over the math on whether it's better to pay off your mortgage early or rather to invest it instead. Usually, if you are asking this question, it means you have some money left over at the end of the month after paying off all your bills. And now you're trying to figure out what's the best way to make use of those extra funds. Now, if this is you, then congratulations, because most people are not in this situation where they have any savings at the end of the month and are living paycheck to paycheck. Have a look at this chart where it shows the amount of personal savings rate in America, which is barely at 4%. Now, to determine whether investing or paying off your mortgage is the best route for you has many factors which needs to be taken into consideration. But the most important one is the amount of interest you are being charged on your mortgage. We're first going to break down how mortgages work, as this is essential to understand so that you know which route is the best for you to take. After understanding that, we can go a bit deeper into the math and understand what makes the most sense for you financially. Okay, so how mortgages work is that you are borrowing money from the bank which you are expected to pay back the full principal amount with interest at the end of your loan period. Now, your mortgage can go up to 20, 30 or 40 years based on the application you made with your bank. So let's say you decide to borrow $500,000 for a 30-year fixed interest rate mortgage. When applying for this loan, the bank will make it really clear for you to know how much money you need to pay back to the bank every month for the next 30 years or 360 monthly payments. Now, each monthly payment is broken up into two components, and this part is critical to understand in answering whether it's best for you to invest or for you to pay off your mortgage sooner. The first part of the payment is used to pay off your principal amount, which is the $500,000. And the second part of the payment is used to pay off the interest which you owe to the bank on the $500,000 borrowed. So for your first month of paying back your loan to the bank, you will be paying them a total of $3,327. Now, here's the really fascinating or messed up part, depending on how you look at it. The banks follow an amortization schedule, which is a table that details your monthly payments owed to the bank. Now, the unfortunate thing with getting a mortgage is that the bank always wants to pay the majority of the bank's interest first rather than paying off a larger chunk of your principal amount first. So what this means is that in month 1, you paid a total of $3,327. Of that money, $2,916 is used to pay for the interest and only $409 is used to pay off your principal loan amount. This is how mortgages work. Banks always want to get paid first. But by doing this, you don't really make a dent into your principal loan amount until years later into your loan. And this becomes a problem where you are never making a dent into your principal amount. It will mean that you will be forever be paying off your loan amount without significantly reducing the $500,000 which you owe to the bank, which can honestly make you feel a little bit hopeless. By following this way of paying back your loan, it is so shocking that in the first 20 years of your 30-year loan period, you'll be paying back more in interest per year than paying off your principal loan amount. If we look at this table, you can see that for 70% of your loan period, or after 21 years out of the 30 years, you will still owe $265,000 to the bank, meaning you would have paid off around 47% of your loan amount in your first 21 years of your 30-year loan period. That is a total of 66% of the duration of your loan. Often with mortgages, the amount of interest you pay outweighs the dollar amount you actually borrowed. By loaning $500,000 at an interest rate of 7% by the end of the 30 years, you would have paid a total of $1.2 million with a total of $697,000 paid in interest, meaning that you paid 58% of the total as a cost to take out the loan. Now, if your interest rate was a little lower at, let's say, 5%, then your total paid in interest would have been less than the principal amount at $466,000. And if your interest on the loan was just at 3%, you would have paid a total of $259,000 in interest over the 30 years. Now, all of this is pretty interesting. If you could get a mortgage with an interest rate of less than 4%, which is really difficult difficult to find, or if we could reduce the principal amount we owe back to the bank as quickly as possible, that means it will reduce the amount of interest that we pay to the bank over the course of the loan. Now let's have a look at the stock market and the returns you get from it, and whether it makes more sense for you to pay off your mortgage early or to rather invest. The general consensus when people say they are investing into the market, they are referring to investing into the S&P 500, which on average returns just over 10% per annum since inception. So it's pretty reasonable to expect to get 10% return on your investment. And after taking taxes into account, you can expect to get around 8% net return. If you have a 3% interest rate and if you make extra payments towards your mortgage, then you are basically making 3% on that money. So mathematically, you're going to be a lot better off investing into the stock market, making a net return of 8% than paying extra money into your mortgage, which will save you just 3%. So let's have a look at the different asset classes and their performances over the last decade. We can see clearly from this image the performances of the different asset classes, and you will notice that the blue colored asset classes, which are the large cap value, large cap stocks and large cap growths, are almost always on top every year. Feel free to pause the video and examine the performances a bit more in detail if you wish. The three different asset classes are largely consisting of the bigger companies within the United States, which is primarily made up of the S&P 500 companies. Now have a look at this chart where it shows the annual returns of the S&P 500. We can see that most years have been in a positive. Since 2009, every year has had a positive return except two. An average out between the 15 years since 2019, the returns have been at 15% for the year, much higher than the 3% you'd pay on your mortgage interest repayments. It is important to know that when you are investing, there is always a risk that there will be years where you will lose money, which is what happened in 2018 and 2022. So right now in the video, we can see that if you have a low interest rate on your mortgage of 3, 4 or 5%, it will always make more financial sense to invest rather than to pay more money into your mortgage. When interest rates are higher at 6, 7 and 8%, then it becomes a little trickier. Some people are going to prefer paying off their mortgage, not because of any financial benefit, but rather the intangible benefits such as having some peace of mind of owning your own home. Let's pretend the interest on your mortgage is 6%. This means it is effectively a guaranteed return of 6% tax-free by paying off your mortgage with any extra money which you may have. While 6% is not impossible to get from the stock market, there is always a risk of a losing year in the market. And now there is one factor which I have not mentioned yet, which is absolutely critical to add into this equation to help answer your question on whether you should be using your extra cash to pay off your mortgage or investing it into the stock market rather. And that is, how many years do you have left to pay for your mortgage and how many years do you have left to invest? Generally speaking, the more time you have left on your mortgage, the better it is to rather invest your money, and that's because of the power of compounding. Now let's say you still have 25 years on your mortgage, but instead of paying off your mortgage, you invest $500 every month into the stock market instead. Now as I mentioned earlier in the video, you can get 8% post-tax returns on average from investing into the S&P 500. Now investing $500 monthly at an 8% return rate for 25 years will net you just over $457,000. Now on the other hand, paying off an extra $500 per month on your mortgage will save you just $208,000. Now you may wonder, why is this? You will notice that in both examples I used 8% as the interest value and 25 years for the term. This is because when you are paying extra money off on your mortgage, you are using that extra money to pay off the principal amount which you loaned, and your savings will be in the form of reduced interest on your mortgage. Whereas when you are investing, you are using the money to grow your investment and will earn interest on it, which compounded over 25 years can grow your money exponentially. So this example is on a 25-year loan period, which clearly makes more sense to invest into the stock market rather. However, it becomes a much closer comparison if you have just 15 or 30 years left on your mortgage payment. In this case, you should run the numbers yourself based on your specific scenario. I'll leave a link in the description box below where you can do the calculations. My two general rules of thumbs in this video are: number one, the lower your interest rate on your mortgage, the better it is to invest. And number two, the longer you have still left on your mortgage, the better it is to invest. Now, important to note that these ideas purely stem from a mathematical and financial viewpoint. Some people may not always look at a home in the same way. The fact that they own a home may mean more to them, so each person needs to understand what route suits them the most. If you want to know how to reduce the amount you pay and the time it takes to pay off your mortgage while still investing, then have a look at my next video up on the screen where I speak about this. I hope you have found some value in this video. If you have, then please consider liking and subscribing. It's absolutely free.